Hello and welcome. 0.5% higher on the Nifty is what we're 0.5% lower on the Nifty. I beg your pardon, is what we're seeing. 24,450-ish is where we're currently trending towards. We're seeing the Nifty mid-cap and small-cap indices largely flat, even though the mid-cap is trading with a mild cut, and so is the small-cap, in fact, with a mild uptick, around a 0.5% higher on the Nifty small-cap index. In terms of sectors and how that's playing out, in terms of the Pharma and the IT index are contributing to the gains, so around 0.5% higher on Pharma, 0.4% higher on IT. Defense is down another percent. FMCG is down around 0.9%. Metals down, and the Nifty Realty also down around 0.6% thereabouts. So that's really the tilt of the trade. In terms of stocks, and let me quickly pull up some stocks, at least from the morning, that continue to do well. Wockhardt, again, good numbers. Gland Pharma is the other one, which is absolutely buzzing. Well, Wockhardt has given up all of those morning gains. Gland Pharma holding up 8% higher. Vodafone, on the stronger than expected ARPU number, 195 is where the ARPU has come in at, and we've seen a decent uptick in terms of ARPU, keeping the stock in the green. Yatharth, Bosch we spoke about, Lumax Auto we spoke about, PC Jewelers and Europratik are just some of the other names which delivered a decent set of numbers, even though you're seeing mixed trends in terms of movers. KC International, Triveni Turbines and Websol is where some bit of the pain likely resides. KC International now down 4.5%. Triveni Turbines also is where the pain resides. You'll see a 6% knock on that stock, and then there's Ramkey and Websol, where there seems to be some pressure which is getting built up. I wonder how some of the other movers are doing. A Zentech, for example, an IRB, a Bharat Forge, which was in the green at the start of the day, likely continues to sit in the green, especially after the kind of move that we saw yesterday. Okay, Bharat Forge down 3%, in fact, beg your pardon. Jupiter Wagons, a 211 crore order, and BEL, a 540 crore order. Railtel also had around 120 crore order wins. So you've got all of those stocks in focus. But are we here with some of the other names that you want to keep on your radar for this afternoon's trade?
So let's have a look at some of the stocks that are buzzing in trade. I would like to start from Bosch, which has come out with its Q1 numbers, and the numbers are a beat on all the fronts, with the sales coming in at 5842, with operating profit at 818, and the EBITDA margins expanding and almost 2% up by what the street was estimating, coming in at 14%, with the profitability at 702%. However, there is a base effect to it and a deferred tax impact, which makes the numbers okayish on a YY basis, and yet the numbers are good and a beat on what the street was estimating. Up next is Zee Entertainment, that has posted a weak set of numbers, although the revenue is up around 4.5%, but the EBITDA is down around 58%, and the profitability is also down 47%. The margins have contracted substantially, and that is the reason the stock was under selling pressure in the trade. Up next is Lumax Auto, a stock that was up 15% in trade because of its on back of its earnings. The revenue was up 32%, the EBITDA margins expanded by 2%, the EBITDA was up 54%, and the profit almost doubled for Lumax Auto. So a strong set of earnings from there, and that is the reason there is a rally in the stock. Up next is Jupiter Wagons, that is also seeing some strong rally on back of an order win of 211 crore rupees from JSW Port and Logistics. And our last pick is Hind Rectifiers, that came out with its Q1 results just a few hours ago, maybe half an hour ago, with revenue up 20%, but very bad numbers on the operating profit, which is EBITDA is down 48% and the profit is down 30%, and that is the reason the stocks was hammered down by around 7 to 8% in trade. So a weak set of earnings from Hind Rectifiers.
Thanks for taking us through that list of all the stocks that are buzzing in trade, some on the back of earnings, some otherwise. But let's focus and talk about the other big talking point of the trading day, and that's the SIP numbers and the AMFI data that we've received a couple of hours ago. The SIP inflows, they remain robust near the 32,000 crore rupee mark. Mutual fund AUM rose to 85 lakh crores in July, while equity AUM climbed to 38 lakh crore. Small cap funds led the category flows, followed by mid cap funds, while liquid funds have seen a sharp turn around. Mitali is joining us with the highlights of this month's AMFI numbers.
Right, so the data coming from AMFI for the month of July 2026 states that a robust set of numbers have come in, and if you see, July was the strongest month. If you see on the overall net inflows basis, which were around 2.36 lakh odd crore rupees, compared with an outflow of nearly 53,000 crore that we saw in the month of June. Also, total AUM, it has moved up sharply in this month to 85.76 lakh crores, up from 82.22 lakh crores in the month of June, while the equity AUM also increased to 38.36 lakh crores. That is constantly increasing if you see in the last few months. One of the biggest drivers was the liquid fund segment's very smooth inflows coming in, which saw an inflow of around 1.19 lakh crore rupees, reversing an outflow of 43,000 odd crores in the month of June. While within the equity, the trend was quite selective. We saw some inflows coming in from mid cap as well as the small cap, but for the first time since December 2023, there has been an outflow seen for the large cap stocks. An outflow of nearly 1322 crore rupees has been witnessed for the month of July. Also, gold ETFs and silver ETFs, they continue to gain that momentum in the positive inflows coming in, and overall ETF flows stood at around 9,512 odd crore rupees for this month. The other major highlight was the SIPs, although a marginal uptick seen on a month-on-month basis, but it is regardless noting that this is the second highest monthly flows in terms of SIP on a monthly basis. So the July picture, it is quite strong in terms of the net inflows, the AUM as well as the SIP flows. Quite selective picture coming in on the sectoral theme, but we will see as to the resilience as well as the sustainability going ahead for the same.
Okay, thank you for that, Mitali. Let me go across to Raminder. Kolte Patil is seeing an uptick on the back of Q1 numbers. Very strong, by the way, the numbers themselves. But Ravinder, give us a sense. How do they look? And give us a breakdown of the fine print.
Well, yes, it was a strong quarter for the Kolte Patil in Q1 FY27, where company revenue jumped nearly 10 times on a year-on-year basis to rupees 920 crore, and EBITDA has also increased to 189 crore, and the improvement was supported by higher revenue recognition as more projects entered the revenue recognition phase, timely project completion, and higher contribution from the high-margin Life Republic projects. And coming to operational front, then however, the company's pre-sales was remained flat on a year-on-year basis at rupees 617 crore, and the collections was a key positive, rising 30% on a yearly basis at rupees 715 crore, and the average realization has also improved significantly to 9,442 per square feet, which was driven by strategic price revision across project and higher contribution from the MMR project. And on the launches front, the company launched 2 projects in Pune, and brokerages has come out with a note, and Motilal Oswal has maintained their buy rating with target price rupees 545 as compared to earlier target price rupees 450. They highlighted that the strong collections and new project additions, although the pre-sales was below expectation, however, they expect momentum to pick up in the going forward, and the recent business development initiative in the Mumbai metropolitan region is also expected to improve growth visibility and provide greater diversification over the coming years. So back of the strong Q1 FY27 earnings and positive brokerage report, Kolte Patil is in focus.
Okay, Ravinder, thank you so much for giving us that perspective. What we'll do is slip into a very short break, come back. We'll speak with Jonathan Chazelle. He's the Deputy CIO at Westminster Asset Management. Interesting times we live in. The 10-year bond yield at 4.7%, which is the US 10-year bond yield. Gold prices back up to nearly $4,400 on the ounce. And therefore, will be good to understand from him what trends are playing out in terms of flows and how India stacks up. On the other side, stay with us.
Back with closing trades, and let's welcome on board Mr. Jonathan Chazelle, the Deputy CIO at Westminster Asset Management. Jonathan, hi. Thank you so much for waiting by so patiently. Just give us a sense of how you're looking at the markets, both globally as well as back home, because there is so much back and forth commentary between US and Iran when it comes to the Strait of Hormuz. Is it open? Is it closed? Oil prices have continued to be sticky around $83, $84 a barrel. And you've also got gold that is once again spiking up. How are you looking at all of these developments playing out?
As you say, it's a push and pull market. There's lots of things to be worried about. On the one hand, And there's also, on the other hand, an underlying economy that still seems to be pretty good, which ultimately is pretty good for earnings, which remain very elevated. And therefore, it's, there's plenty for the bulls and the bears to feast on at the moment. I think all in all, we are, I guess you wouldn't call us neutral on equities. We're probably slightly more bullish, but very conscious that there are factors at play which could change very quickly, obviously in the Middle East and other conflicts globally. So yeah, it's tricky. And clearly behind all of this is inflation. And that's the key point, what's happening with interest rates, both short-term and long-term rates. And that ultimately will influence pretty much everything going forward.
And Jonathan, interest rates will be influenced very likely by crude, and crude is so volatile. What's the sense like? What are you penciling in terms of the print this time around? A couple of days, or rather tomorrow, right? So tomorrow, US time. What's the CPI print expectation?
Look, I think obviously the last number we had was a bit weaker than expected. Clearly, I think, as you mentioned, crude and inflationary pressures, to our mind, are going to be building and become increasingly evident. We don't think the Fed's going to particularly react to any, even if inflation comes in slightly stronger. We think the Fed is going to sit on its hands for the time being for various reasons. But certainly we as a house are more on the inflation is a problem sort of seat. And we think we're currently moving in to a global picture, which is we've still got decent growth, but we've got an inflation problem coming.
When we were speaking, I remember you did say that the route that we were seeing in some of those AI-related stocks, that correction was overdue and necessary. What are you making of the global IT sector, especially when it comes to AI, and how are you looking at this sector for India?
Yeah, it's clearly the software space which has got so brutally derated globally and within India. Clearly, we've seen a bit of a rebound over the last month and a half. We've seen that in India. We've seen that also globally in a lot of these stocks which were viewed as at risk from AI. I think, though, from our perspective, nothing has really changed. These stocks were oversold. Some of them clearly are still very important and will play an integral part in, some of their clients going forward. But there is still some doubts about the business models going, as we move ahead and how AI will impact that. So it's leaving us on the sidelines. We are not going to chase up some of these recoveries because of that uncertainty. But there are certainly stocks which we think will survive and will utilize AI and do very well out of it that have been brutally oversold. So, on an individual stock basis, there are some interesting names, but broadly speaking, I think, there is still uncertainty in certain sectors. Obviously, the AI trade, what we've seen so far over the last few months is a very quick rotation. Initially, but obviously quite a few months back, it was the sort of magnificent 7 names that were leading the initial rally up. Then that rotated into the memory makers in South Korea and elsewhere. And that's obviously coming into a little bit of a headwind at the moment as those stocks did so well. I think we're just going to see this sort of, continual rotation from one perceived winning sector to the next over the next few months. But in the short term, probably the memory stocks had done too much, and some of them have come down, a fair way. Yes, they're sort of stabilizing, but it's difficult to work out really what to do with some of certainly the memory names, which are very cyclical and have rallied and come back a little bit. We do sort of agree with the view that for the memory makers themselves, that demand will look very robust for a long time coming. But obviously, the point being is what price are you willing to pay for all of those companies? And that's where it gets more complicated.
Jonathan, the other piece that's at play is that there is a rotation towards real assets. not just gold, but also oil and gas, also steel, also basically commodity-led or driven. How do you see that trend play, and where exactly in the cycle are we globally? You understand Asia really well, and of course the globe. Give us a sense of that.
Yeah, so I totally agree with that trade. We ourselves have been quite bullish on commodities for some time, and real assets, as you say. I think real estate is a bit more difficult, but certainly if you're looking at equity markets, some of the more cyclical companies that own actually real assets, I think will look, interesting going forward. And this is, after all, a way to hedge yourself against an inflationary environment, which we believe is coming up ahead. So yes, I think the push into commodities have a lot further to run. Like all of these things, there'll be ups and downs, but we are still quite bullish on commodities. Oil, and we've discussed oil a little bit at the beginning. Oil to us still looks, quite mispriced for everything that's going on out there, and oil still looks quite cheap, certainly very cheap compared to gold. So yes, all in all, though, we do like and continue to like commodities and real asset plays going forward.
Those are a couple of baskets that you're liking. Jonathan, what else is looking attractive amid a market like this? Any other themes, sectors that you are right now bullish on?
Yeah, I think, again, a sector that's done reasonably well, maybe not so much in India, but globally, is financials and banks. Obviously, they're benefiting from the rising yield curve. So banks have been doing pretty well globally. I think, as I mentioned at the beginning, the global macro situation is pretty positive. We're seeing a broadening out of capex, particularly in the US, into other non-AI related sectors. Banks are obviously going to be lending into that, so we think the banks look pretty good globally, and I think that will come to India. The Indian banks have recovered a little bit from their recent lows, but they're not sort of pushing up to new highs that we're seeing in some other markets.
And Jonathan, when do you see flows come back into a country like India? The timing of it critical. You've seen enough cycles, and I'm hoping that you can throw some of your perspective at us.
Well, when we look at emerging markets or markets globally, India is one of the exceptions, which has actually seen quite a significant derating over the last couple of years. I think, I guess it's why is India derated and why have other markets re-rated? I think, quite interestingly is, earnings, the earnings season and the earnings outlook in India looks good, but it looks good everywhere else. But everywhere else, we've seen actually earnings driving some markets. So we've seen the rating not moving up too much. India, on the other hand, as you rightly point out, we've seen a lot of foreign money coming out, chasing the AI trade elsewhere, which unfortunately India doesn't have a great representation to. I think it'll change, though. I think as we move through this AI trade, and the market's looking for evidence of companies who are going to start benefiting from adopting AI, be it the actual the guys who own the models, the big AI model owners as such, like Google and those guys. There's little evidence they're making money out of it. But I think more importantly, looking for companies that are adopting AI and using that as a productivity tool. And I think that will come, and I think that will ultimately benefit greatly a market like India. But in the interim, unfortunately, the IT sector, I think, as I said earlier, it has had a run, but there is still some uncertainty there. But otherwise, moving out of that, then the banks look good. I think the consumption side still looks attractive. And I think, broadly speaking, investors will be looking keenly at India and when to reallocate into it, but probably not just yet, because I still think we are in the midst of this AI excitement.
Hoping for that and a relook from the FIIs towards the Indian market. You did say banking looks good, consumption also looking good at this hour. Jonathan, really appreciate you taking the time out and speaking with us today. Thank you so much for your time.
Thank you.
Thank you. Viewers, on that note, time to slip into a very short break on this edition of Closing Trades. Lots of conversations lined up on the other side. We'll bring you a technical view on some of the top buzzers of the day as well. So stay tuned and we'll be right back.
Welcome back, and plenty buzzing. And before I take you through some of the buzzers, let's bring on board Shivangi Sarda to contextualize the moves in the market. 0.5% lower, Shivangi. We're now slipping to 24,400 again. Concerned?
Very good afternoon, Harsh. Thank you for having me. So we've seen that the indices have been facing some bit of pressure, and from the last 5-odd trading session, we've seen that resistances have gradually shifted slightly lower, with some bit of call writers strengthening their position at the higher levels, around about 24,700 marks, where the resistance is lying right now. But overall, we're seeing support-based buying is still intact, and we've been holding the low of both August. So overall, quite range-bound move. Today's expiry was pretty dull as well, with a very consolidative move after the negative opening. But overall, we're expecting some bit of support from Bank Nifty. Till then, we will continue to remain in pressure, and 24,350 is the next support that we're looking out for in the Nifty index, with the upside hurdle at 24,500 immediately, and then 24,650. So this is the take on Nifty. But of course, when we look at Bank Nifty, we've seen that some bit of underperformance is seen here, and whatever little strength can be seen in Nifty today has been a result of the IT space as well. But overall, Bank Nifty also is in a little bit of pressure, and till the time it holds below 57,500, we may expect some range-bound move over here.
Okay. First of all, belated birthday wishes, Shivangi. Good to have you on board. Give us a sense of how you're looking at some of the defensive themes, particularly pharma and IT, since they're the couple of only sectors that's holding on to the green today.
Thank you so much for the wishes, Snehi. And looking at the entire pharma pack, I think this one has been quite resilient. And I'm looking at Laurus Labs, which has been on my radar, since the last, I think, 15 odd weeks. This stock has given remarkable follow-up after the breakout, and every small bounce has been utilized. The volumes are significantly higher this series so far. And we've seen that, even though it is consolidating at the higher levels, but overall momentum is quite strong for this one. So Laurus Labs would definitely be on my radar. Apart from this, I think some of the diagnostic space stocks could be kept on radar, but the other stocks which are on radar are some of Dr. Reddy, for that matter, which is looking quite positive. So this is the space you can look out for.
Right. And Shivangi, wasn't aware, but wishing you a very happy belated birthday. I hope you had a good one. I mean, where's the party? I'm sure it's going through the week, right?
You and Shivangi need to give a party together, because Shivangi, Harsh and you share the same birthday.
Scratch that. Shivangi, where's your party?
That's lovely. Thank you so much, Harsh, and wishing you the same as well.
Thank you.
And of course, I think both of us need to give Snehi a party now.
Absolutely.
All right. Shivangi picks. Give us something to work with. Give our viewers something to work with. A bit of a birthday present.
Okay, I think birthday present, if we talk about, I think it will be a little long-term, say about a Titan, which has been quite strong. We've seen this one has seen a good amount of open interest addition. From the last 10 sessions, we've seen consistent buying, higher top, higher bottom formation as well. And from the last 2 days, open interest has been significantly high. So this one's definitely on my radar and one of my favorite stocks as well. We're looking at Titan for a little positional view, and 5,400 is the next target, what we can look out for, with a support base of 49.50 levels. On an immediate trading perspective or a BTST perspective, if I may say, then I am looking at Eicher Motor. This one's looking quite positive. It's come off a little bit from the day's high, but overall, from the auto pack, this one's pretty strong. And we've seen that one of the most resilient stocks, the weekly chart structure is also quite positive, and one can look at 83.20 levels for this one next with a support base of 78.70 levels.
Particularly ask you, Shivangi, with regard to InfoEdge as well. Some very strong moves over the last couple of days on this stock, and understandably, the numbers were strong. But chartically, what changes?
So looking at this one, of course, this one has driven the entire IT pack of lately, and of course, aiding the Nifty gains as well, whatever little that we are in today. So, we've seen that this one has given a consolidation breakout of the last 24 trading sessions, and even after the retracement level, we had seen that the momentum was slightly low, barring the last 2 days where volumes have significantly shot up. So, of course, this is one confirmation that the stock is resiliently holding on to the higher levels. And even despite the market weakness, we've seen this one's contributing and resiliently staying at the higher levels till the end of the trading hour. So overall, pretty strong, and we're expecting the next targets of around about 1430 levels. That is what I see. Yes, and a support of 1350 zone.
Levels to watch out for on InfoEdge, one of the top gainers from the broader end, a 7.5% uptick coming in, and that rally on the stock continues ever since it reported strong set of numbers yesterday. We're shifting focus to the pharma space and healthcare in particular. A parliamentary health committee has reportedly recommended capping private hospital room charges in metros at the rates of nearby 3-star hotels. The proposal is not yet government policy or a mandatory cap, just a suggestion as of now. And Meryl is joining us with the details of this. Meryl.
That's right. So, a Parliamentary Health Committee has just recommended a bunch of changes, and one of them is capping hospital room rates at the same tariff as nearby 3-star hotels. Now, what this is aiming to do is address the major gap that is currently in place among healthcare costs. We're seeing average hospital costs as of now stands at around 50,500 for a hospitalization in a private hospital versus 6,600 in a public hospital. This makes private healthcare up to 5 times more expensive and up to 10 times more expensive in certain metro cities. But apart from this, the committee is also recommending fixed package rates for standard procedures, upfront cost estimates that can be legally enforced upon the hospital for the complex treatments, and also greater transparency in bills as well as insurance. On top of that, they also want the government to expand the public healthcare capacity, and they've also called for a review of FDI rules around foreign ownership and management of existing private hospitals. So while this is only a suggestion as of now and not a government mandated cap, any future implementation on this could have a meaningful impact on private hospitals' pricing, profitability, and also how much foreign investors can actually invest in these hotels. We've seen a lot of foreign-owned hotels, especially now the major Manipal Health IPO, which is largely backed by Temasek Group, and a lot of major hospital brands are also backed by FDIs. So even that is why we're seeing the certain moves in hospital shares right now. We're seeing the likes of Apollo Hospitals, Max Healthcare all fall down on the back of this parliamentary committee hearing.
Okay. Thank you so much, Meryl, for that. We'll submit a very short break. On the other side, we'll continue chatting with Shivangi. We'll also have a corporate conversation slotted for you. Dilip Buildcon. We'll speak to the management on the other side. Stay with us.
Back with closing trades, and good to have you back with us. We've still got Shivangi Sarda in conversation with us on the technical front. Shivangi, give us a sense on some of these upstream oil companies that we're seeing quite the outperformance there today. Chennai Petro is up about 14.5%, MRPL up 10%. You've got Oil India that's up about 4 to 5%. What should the strategy be here? Book profits, if at all, and what are some levels that you're watching out for?
Definitely, these stocks have done pretty well, and we've seen that from the first tick itself, this stock has seen buying interest emerging, and it has seen slow and steady gradual up move till the end of the trading session. So, of course, this one is adding good volumes towards the end as well. So this one should be kept with, of course, a trailing stop loss, and the next levels that we could look out for this one is around about 1460 odd levels on an immediate basis, and then 1500 levels slightly positional, and we could put a stop loss of around about 1380 at these current levels.
Okay, appreciate that view. Shivangi, on that note, we'll let you go. Thank you so much for your time today, and good to be speaking with you. Okay, on that note, viewers, let's refocus and put the spotlight on a corporate conversation on the back of earnings. We've got the management of Dilip Bilkon joining us on the show. We've got Mr. Rohan Suryavanshi, the head of strategy and planning at Dilip Bilkon. Before we start the conversation, just want to take you through what these numbers look like, slightly on the softer side for the first quarter. Revenue looking good. There's been a degrowth of 9.3%, but continues to be ahead of estimates. The net profit has come in at 113 crore rupees, which is down about 51% on a year-on-year basis. The EBITDA is also down 17.5%, and we've seen a slight bit of a contraction coming in on the EBITDA margin front as well. Just trying to understand what is the outlook going ahead. Let's take the conversation ahead. Mr. Suryavanshi, hi, good afternoon, and thanks for your time. Give us a sense of how the first quarter has been for you, and going ahead, what's a sustainable margin number that you're seeing? Any visibility on margins crossing 20%?
Hi, first of all, thank you for having me on your show. So the quarter first that in the construction sector is usually a quarter that runs kind of softer than the quarter four, but the real revenue in our sector comes in quarter three and quarter four. So quarter two will be softer because it's the rainfall sort of quarter as well. But our full year guidance, our full year sort of outlook remains very optimistic, and we've already guided the market towards a 30-40% top line growth. And the EBITDA range that we mentioned is a 10 to 12% EBITDA. So we're very confident about all of that being met, because we have a very healthy order book currently in hand, and it's a very diversified order book. So all the orders that we'd won last year, they will start throwing revenue in quarter three and quarter four.
Rohan, hi, this is Harsh. So I'm trying to therefore get a sense, how is order flows panning out for you? How strong are order flows? Are we seeing an increase at all? And how's order winning playing out? What's the L1 pipeline? How much do you intend to win?
Hi, Harsh. Or the first half of the financial year is typically softer in terms of the order flow. The orders usually come in the second half of the financial year. That's been the trend for the last many, many years. The order pipeline, I'm happy to report, is extremely, extremely robust. Currently, we are in the process of evaluating about 2.5 lakh crores of orders, out of which about 1,30,000 crores are in the road sector, and about another 1,20,000 crores are in the other sectors that we operate in. So it's a healthy pipeline that we're looking for. And even in this year, we've already won orders of about 3,000 crores already. And our full year guidance for this year was about 10-12,000 crores. So we're very confident that we will achieve that number.
And typically, when you win these orders, Rohan, is there a pass-through with regard to raw material costs? Because those would have likely climbed. There were also certain labor issues which got faced by some industries in Q1. Did you face those as well? Anything in terms of that topic which you can throw some light on?
So there is not a complete pass-through of costs, especially when the costs run up in such a sudden manner as what we saw what happened post the US and the Iran sort of crisis. There was a sudden jump in all raw materials, and obviously our contracts do not absorb all of it. So some of it is obviously the companies had to absorb. On some part, the governments have assured that they will try to do what they can. But the short answer, it's not a completely absorbing. It's not something that's completely absorbed in the government contracts. Though going forward, as we see that this situation kind of wanes down a little, I think we should expect a more normalized margin profile going forward.
Okay, and lastly, just want to get a sense on your debt picture. You have guided to become net debt positive by FY28. Are you on track for that?
Absolutely. We have guided the markets towards that. Had we not been investing in our assets in the last 2 years, so DBL from its own balance sheet has invested about 1,200 crores plus in building an asset portfolio, assets which we are now going to be transferring into the InvIT. Of all the investments that we've made, we will be holding about 3,000 crore plus of InvIT units, which will provide long-term cash flow visibility for the company. Even right now, I'm also happy to report that we had won some solar projects and we had won some transmission projects, both of which we are now looking to divest to Alpha Alternatives, our partner with whom we set up our InvIT. So there is a constant capital recycling exercise that's happening, plus the new orders and the profits that we'll get from them, all of them will kind of help us in achieving our debt reduction goals. So on a standalone basis, I'm fairly confident that we'll be a near net debt zero company in the next 2 years.
Last off, Rohan, just very quickly. So the fact that margins might take a knock, just given the way raw material prices have moved, does that bother you? Does that probably in some form or shape leave you cautious with regard to your full year FY27 guidance for margins?
I don't think there should be a meaningful erosion of margins, because this is a temporary scenario, and for me to kind of imagine that it'll continue for a year and all these prices will remain elevated is slightly difficult, and I'm not the best person to kind of judge that. But based on whatever we've seen happen in the last quarter, I think the more realistic estimate is that all of these situations should kind of normalize, and we should see a more normalized margin profile going forward. And along with that, like I said, some support from the government would also help in keeping things sane for the whole industry.
Rohan, thank you so much for joining us and giving us that perspective. We'll let you go.
Thank you very much.
Thank you. Okay, we'll submit a very short break, come back, plenty to speak about. Stay with us.
Back with closing trades, and let's welcome on board our next set of guests. We've got Mr. Anand Tandon, independent analyst, being joined by Mr. Rajesh Bhosle, senior technical analyst of My Advisor Alpha. Gentlemen, good afternoon and thank you so much for your time. Anand, let's begin with you. You know, amid a market like this where we've seen choppiness for a second straight day, you've still got some specks of green coming in from pharma, IT. To some extent, you've got some parts of financials that are participating. How are you looking at this theme that defensives are once again coming back to the green, and you've got some other sectors like realty, metal, defense, they are all under pressure? Do you believe that this trend is here to stay, at least for as long as the market continues to be sideways?
Sideways market, you expect to see sector rotation as the primary theme. That's pretty much what we seem to be seeing right now. There is, though I think the earnings for this quarter have been somewhat decent. In fact, there have been some few positive surprises from the consumption side, especially autos and auto ancillaries, plus perhaps some of the FMCG as well. for the most part, the rest of the market was already anticipated that they will do well. So, for example, engineering and kind of companies, for example, were already expected to do well and have delivered accordingly. Which means that leadership still remains a problem. There is no clear sector which one can expect will do very well going forward, and therefore rotation will be likely continuing. As you mentioned, pharma, etc. While there are some things that actually India has a fairly good position in, there is also now that the color that is coming through of what happens 2 years out, and that will change the kind of positioning for some of the companies. But pretty much otherwise, export-oriented businesses should continue to do reasonably well, barring IT. And the domestic side, the consumption, as I said, has been a little better than anticipated.
Anand, hi, great having you. Rajesh, I'll come to you in just a minute. Anand, I wonder how you're looking at the entire consumption basket. I mean, you spoke a little bit about auto, but there's also QSR out there, which has done, much better than expected, even though these companies are still largely loss-making, the largest ones still to come out with numbers. But give us a sense, is the tide turning? Is the worst over likely? And, do these companies now turn profitable at some point in this cycle?
Well, I don't know whether they will turn profitable or not in this cycle, but there is definitely, for the first time after many quarters, we are beginning to see same-store sales growth picking up, and that's an encouraging sign. Also, we are entering the phase of the year where the second half is usually better for consumption anyway because of the set of festivals and the overall number of holidays, etc. So overall, I think QSR space may actually benefit from all of that going forward. One of the major issues with this space has been the fact that the valuations have been overstretched compared to the kind of growth. So to some extent, that has now got corrected. Net, as I said, from a consumption theme, I think QSR probably has reached its bottom. How quickly it will rise is another question.
Watching out for that, because this quarter you've got a very good set of numbers from Sapphire, Devyani, Westlife, and we've got Jubilant also later in the week, so we're going to be watching out for that. Rajesh, we'll come to you. Thanks for waiting by. Give us your sense on how you're looking at the charts for the broader end of the market. We understand that Nifty and Nifty Bank are slightly under pressure, but even between this mid-cap and the small-cap indexes, you've got a reshuffle of leadership coming in on an everyday basis. How is the broader market shaping up on the charts?
Hi, afternoon, and thank you for having me on your show. So the broader view remains of sector rotation as just we highlighted. If we see for the Nifty and Bank Nifty, they are placed at a crucial resistance level, and they are struggling to cross those levels. And in fact, we are seeing that the short-term support levels have been broken today, and market may remain in a consolidation phase. But some sectors like auto, IT, they have been outperforming in last few weeks, and the kind of structure they are placed at a strong daily and weekly chart structure. We expect this outperformance to continue. Even if we see mid cap and small cap, they are trading flat and are showing relative strength as compared to the benchmark indexes. So stock specific and sector specific would be the approach in the coming week.
What would those sectors be? Let's start with that, Rajesh.
So as I highlighted, IT and auto remains our top pick, and along with that, if you see capital market space such as BSE, MCX, CDSL, even those are showing traction and possibly the kind of base formation which we have seen in the last few sessions. These counters can show traction from here onwards.
Okay, understood. And since we're speaking of IT, brokerages have remained largely positive on Info Edge after a strong first quarter, citing better execution, accelerating recruitment billings, and improving margins. They see further upside from AI-led products, premium hiring, and operating leverage. That stock is continuing to gain for a second straight day after posting very good set of numbers on the back of a thumbs up coming in from brokerages. And Mitali is joining us with a roundup of all of these brokerage verdicts on the stock. Mitali.
Right, so we see that Inflows has been in focus in today's trading session after delivering a very strong set of numbers for Q1 FY27. And if you see, the brokerages are also quite constructive on the stock, with 3 brokerages giving a buy rating to the stock and Motilal Oswal being neutral. And the target prices range between 1250 to 1520 rupees. Now, the brokerages, the broad consensus is that the improving execution, the better margins for this quarter, as well as the strong recruitment billings are driving this positive outlook on the stock. Although a broad-based recovery in hiring is still awaited going forward as well. Also, recruitment, that remains the key bright spot for the company, with underlying billings growing accelerated at around 15 to 18%, led by GCC, as well as the technology hiring, led by products and higher ARPO as well. Premium hiring has performed even better, which has grown by nearly 25 to 30 odd percentage, while Naukri's B2C business has grown by 35%, supported by better paid conversions as well as self-serve adoption by the company. At 99 acres, the billings have rebounded, with brokerages seeing lower competitive intensity and also improving margins. Although the pace of revenue growth, that still remains a watch point. Meanwhile, Inflows' new initiatives are also gaining traction. AI Rex has around 10,000 free trial clients and across 700 paid users as well, while Talent Pulse, Job Hai, 99 Shots and Naukri Pro, all these are also quietly scaling up. So overall, brokerages see better cost control across the company, operating leverage, premiumization, as well as the AI-led products supporting the earnings growth. And yes, you can see a positive momentum on the stock as well.
Absolutely positive momentum over there. Thanks, Mithali, for that. 6.5% uptick coming in on InfoEdge right now. Rajesh, other than InfoEdge, since you did say that you're liking IT at the moment, month to date, in the last 10 days or so of this month, you've already seen a 21% run up in Coforge, a 20% jump in LTM. TCS itself is up 18% in the last 10 days alone. Further upside visible on the charts from here?
Definitely, we are strongly bullish on the IT space, and we sense that this move has just started. If you see the long-term chart for the IT basket, I mean, during the July month, we have seen a bullish engulfing pattern on a multi-year low. And this kind of formation generally leads to a strong follow-up move. And we are seeing a majority heavyweight IT packs crossing above key averages after a long time. So we expect this move to continue. But having said that, since we have already seen some traction in the near term, this should be considered as a buying opportunity. And in the next few months, we expect the IT space to extend its northward move.
Recall having a conversation with you with regard to IT. Where do you sit on in terms of the argument? Anand, that's for you on IT.
Okay. On my views on IT, I think it continues to remain the same. It's at best a hope trade. It had fallen off a cliff, so therefore it is, bounce was due tactically. Therefore, you might want to play it. I see nothing changed in the fundamentals. It remains fairly weak. So we are not talking about InfoEdge kind of companies here, which are not really IT, which are indirectly affected by IT or recruitment. But I'm talking about real IT services companies. If you want to look at IT services companies, why bother about India at all? Look at Accenture, go buy that. It is 1.2 times sales. It is trading at 14 PE, which is perhaps less than what most of the Indian IT companies are trading, and it will continue to at least grow in double digits, has a much better, consulting business. So I don't see any excitement in the Indian IT services space other than trying to trade it.
That's your view on IT. But shifting focus then, Maharashtra's FDA has suspended the food license of Blink Commerce, the entity operating Blinkit for its Malad West dark store. The action follows an August 7 inspection that found severe hygiene violations, including heavy cockroach infestation, expired and damaged food products, improper storage and poor waste management. Times Network's Paras Dama is joining us with an on-ground report.
It's been few months where FDA Maharashtra is continuously raiding places where there are hygiene problems. There have been raids on famous restaurants and eateries where there are hygiene problem and rules are not being followed properly. Now on 7th August there was a raid conducted by Maharashtra FDA at a Malad blanket godown store where we are right now standing over here. There were many hygiene problem which was found. With that there were expiry date products which was there inside this very store. This is a store from where many people order the product, and from here the product goes to the customer. With that, when FDA raided this very place, there were cockroaches and rats which was found inside the baskets of storage of fruits and vegetables. With that, now the license of this very place of Blinkit store in Malad West has been suspended by the Food and Drugs Department. When there were the raid was conducted over here, there were many flaws which was also found. There were many hygiene problems which was also found inside the store, and acting on this very raid, the license of this Blinkit store has been suspended by the Maharashtra FDA. Now the operations of this very store has been closed for now, and it will be very interesting to see how FDA will work on this entire scene from here.
Okay. All right. Thank you for that. And let me switch focus. Plenty of buzzers, and you're seeing some very good moves coming. There's Finolex cables. The stock is up 15% on the back of numbers. Anand, surprisingly, despite the raw material price inflation, we've seen good numbers coming in from cables and wires companies. Pretty much most of them have surprised on the upside. KEI's numbers are strong, so is Finolex. Polycabs weren't too bad either. RR Cable was also fabulous. Give us your sense on this entire space. It seems to be heating up. There seems to be some upside even in terms of margins.
Everything in terms of power has actually been doing well, given the kind of growth we are seeing in data centers and such like. And that is not only based in India, but some of these companies also sell overseas. Margins will be a problem. Copper prices have been up, but too many of them, I think, given the fact that there is been a sudden surge in demand, I think the margin picture also will be okay, because you'll be able to pass on most of the price increases, given that it's obvious where the commodities are headed. Net, I think for the near term at least, the demand from power-related engineering and supplies companies is expected to remain fairly robust. The only question you have to look at is whether you want to buy at the valuations that they're trading at, given that there is actually very little entry barrier or technology that is involved in, for the most part, in some of them. There are, of course, companies which are involved in slightly more sophisticated wire productions and so on, which may deserve to trade at a slightly better valuation. But net, I think the sector is still fairly expensive, though growth is a given.
That's your view on wires and cables. Anand, also give us a sense of where do you think the run-up has already happened, and maybe there could be a correction that's due in any sectors that you are cautious on right now?
So I don't want to hazard where the market will do. Market does things which I cannot explain. What I can try and look at is where I think valuations have run up. So for most of the well-known sectors where expectations were high, they continue to remain high, and so far they continue to deliver. So as I mentioned just now, power is a clear winner there. Most of the power and supporting infrastructure is doing quite well. Autos also, to my mind, have actually run up quite a bit. Auto ancillary somewhat are a little more insulated because they also export, but by and large they are also not trading at something which gives you a lot of valuation comfort. The surprises, as I said, in this earnings have largely been in the consumption space, and therefore you may find a few winners if you dig deep enough, and which are not directly FMCG or consumer durables kind of things. And that is probably the only place where I think valuations may, aside from banking, be relatively cheap. The banking space, of course, has not been doing well from a stock market perspective, but has continued to perform very well at some stage, I think that is something that one will have to come back to whenever the foreigners return, because they are the ones who tend to lead with the larger cap companies.
Okay, what we'll do is slip into a very short break. Anand, Rajesh, be with us. The cash segment has started and we'll give you, the viewers, an update with regard to how that's playing out. We'll also give you Anand's view with regard to this new mechanism of market close. We'll talk a little bit more about all of this on the other side. Stay with us.
Back with closing trades, and let's put the spotlight on some of the earnings candidates in the last 30 or 40 minutes. One of them is Zydus Life, has reported a mixed first quarter, but the street is clearly giving this stock a thumbs up. Let's pull up the stock price of Zydus Life and take a look at what's happening over there. Because while you've got the revenue that's risen 22%, you've got a cut coming in on the bottom line to the tune of about 36%. But the stock is higher by about 6.5% and continues to do well under cash as well. Let's take it across to Meryl, who's here with the number breakdown and how the quarter shaped up for Zydus Life. Meryl.
That's right, Snehi. So, as you've seen, the profitability for Zydus Life Sciences in the first quarter has definitely come under pressure. PAT is down by almost 36%. But what seems to be driving the stock, first of all, is the strong top-line performance. Revenues grown by 22%. But other than that, India formulations for the company has grown by 20%, which has outpaced the rest of the market. Zydus has also outperformed the domestic pharma market across key segments such as chronic, acute and super specialty segments. International markets was another bright spot for the company, with revenue up 34%, with consumer wellness business surging up to 67%. This has in the first quarter contributed up to 18% of the company's total revenues. And in the US, while revenue was down 3% on a year-on-year basis, the base business actually gained market share through volume growth as well as new launches. On top of this, the company also launched its very first US biosimilar and completed the acquisition of Assertio Holdings, which has strengthened its specialty pharma's presence. Now, looking at why the profitability has come under such pressure, this seems to be clear. The company has reported an 8% of R&D to sales. That's a 642 crores in R&D spend that they've done in the first quarter. They've also spent around 585 crores towards organic capex in this quarter alone. So despite the 36% depression that we're seeing in the profit number, the street appears to be focusing on the strong growth in the company's overall business across its geographies and high value segments, and also the heavy investing that it's doing into its future growth as well.
Okay, thank you so much for that, Meryl. Rabinder here also with Finolex cables. Those numbers were also quite strong. Rabinder, what contributed to the strength in terms of the numbers?
Well, as Finolex Cable reported a very strong set of number in the quarter gone by, with the revenue uptick of approximately 53% on a yearly basis, and Street was estimating a revenue of rupees 162 crore, and company reported actual revenue of 249, and the revenue growth was mainly driven by the strong growth in the company's electrical cables and communication segments, as company's electrical cable revenue grew by 47% on a yearly basis to rupees 1767 crore, and communication also segment also grew by more than 62% on a yearly basis at rupees 176 crore. And if we talk about the margins, then company's margin has expanded from 9.8% to 12.2% in the quarter gone by. And if we talk about the FY27 margin, then in Q4 con call, company has said that the FY27 margin is expected to improve as higher input costs are passed through, and preform integration could provide a 5 to 10% cost advantage when stabilized. And on the capex front, FY27 capex plan is around 300 to 200 crore for the new capacity and 100 crore for the optical fiber expansion. And on the management also highlighted that communication is the key growth drivers for the company as fiber prices are recovering. So overall, it was a strong quarter for the Finolex cable in the for Q1 FY27.
Okay, Rabinder, thanks for taking us through that. Just taking a look at how the cash segment is shaping up right now. We've got about 4 minutes till that segment comes to an end. And some of the biggest movers from the cash segment right now, Jubilant Pharma is up about 3% since 315. RR Kabel is up 1.5%. Eclerx is up 1.25%, as is the case with the Kalpataru projects as well as the Chola Financial. In fact, on the flip side, what's taking the biggest knock is Balrampur Chini in the last 13 odd minutes, that stock is lower by about 3% on the back of its earnings. Remember, in the spot also, the stock saw a little bit of a knock as its earnings came out. Minda Corp is the other one, 1.5% lower, as is the case with NLC India as well as DLF. These are some of the top movers in the last 10 to 12 odd minutes. But we were speaking of wires and cables. We've discussed that on the fundamentals. Before that, Meryl was breaking down Zydus Life's numbers for us. Anand, your view on Pharma, how are you looking at this segment? Because, you know, we've got themes like GLP-1, then you've seen CDMO play out its run. Do you believe that there is still more leg room for some of these themes? And do you believe structurally Pharma is a good space to be looking at right now?
Okay, I think there are more than $200 billion worth of goods going off patent in the next few years, and that gives you a very strong pipeline for complex molecules to be made in India. Many other companies are looking at biologics and so on to expand their portfolio. So I think you will see that both with the regulatory push coming from the US of putting tariffs, and the fact that there is now a larger portfolio again available of off-patent drugs, the Indian pharma industry should be moving up in terms of more complex molecules that they are making. Challenge, of course, always remains the API, which is imported from China. But there again, because of the schemes of the government, there is some incentive now to actually integrate backwards as well. So I think from a purely business perspective, it's a very sweet spot for the industry in general.
Okay, and Rajesh, what is your take with regard to pharma in particular? Any top picks within the pharma basket that you're liking?
Yeah, we remain positive on pharma and healthcare space. One of the strong performer has been Divi's Lab, and today as well we saw a continuation pattern flag breakout. So possibly Divi's can head to further towards 8800 to 8850 levels. So by on the kind of counter, it's a performer, and possibly 8850 to 8900 can be expected in the near term.
Okay, that's on Divi's Labs. It's almost the closing of the cash market. It's a 0.5% trim coming in on the Nifty. 24,450 is where we're at. Although IT continues to do well, the Nifty Bank continues to be under pressure, lower by about slightly more than 0.5%. And mid-cap under pressure, small cap continuing to hold on to gains. So that's the kind of move that we've seen. And the India VIX has cooled off by 3.25%, at least in the cash market for now. So that's the trend that we are seeing. Just taking a look at some of the outperformers from the broader end of the market, you've got a good move coming in on Finolex Cables, Chennai Petroleum, MRPL, Gland Pharma, Amara Raja. Amara Raja seems to be an interesting one. Can you give us your view on the charts, Rajesh, on some of these battery stocks like an Exide and Amara Raja perhaps? How are they shaping up?
Both the counters looks good, especially if we see Amar Raja battery. It was down yesterday, but there is a strong traction today, and it has surpassed its previous swing up. So technically, there is a cup and handle pattern, and over a period of 2 to 3 months, the prices can move towards the levels of 1050 to 1100 levels. So any dip towards 950 can be bought in Amar Raja. Similarly, if we see Exide, I mean, it has been in a vertical rally. Today it was a bit flat, but overall remains a bound dip. Any dip toward 470, 475 can be bought, and in the near term, possibly 510 to 520 can be expected.
Okay, interesting. I wonder, Anand, what you make of this entire mechanism of market close, the new one under CAS?
I think it is a little early to comment on it because there are so many changes that it is becoming difficult to figure out whether or not the liquidity will increase. So in theory, I don't see too many issues with the kind of mechanism that has been put in. Practically, there are some problems. It seems some brokers are not able to see the prices at which the auction system will match. There is also the fact that there is not yet enough generation of orders to take care of this advantage between the fluctuations between the cash closing and the FNO closing. So I think you'll have to give it a little longer for it to actually work and see how it goes. For now, obviously, it has created some disruption and a reasonable amount of uncertainty. The one positive you can take away from this is that people have to now make sure that they kind of close their positions before 3:15. Otherwise, they are exposed to unnecessary volatility on the last day, and that is not bad for the market because carrying forward everything and it actually opens you up to much more risk than people seem to understand.
Okay, and your take, Rajesh, very quickly.
So we are very in early days. We have to see how the liquidity works. It's markets are getting better if we see in last three sessions. So liquidity remains a main concern, especially for the low liquid counters. But as we move ahead, maybe we'll get better and better.
And here's hoping for that. We're going to take a pause in that conversation, take a look at the Nifty 50 earnings so far. They've largely been in line with expectations with results from 46 of the 50 companies out. Consumer services, consumer durables, auto and capital goods are driving revenue growth. And at the other end, you've got FMCG revenue that's up just 1.3%. Ashesha is joining us with a roundup of how this earnings season so far for the Nifty companies has been like. Ashesha.
Well, yes, 46 on 50 Nifty companies have already reported their numbers, and let's take a look at how the scorecard looks like for those 46 companies. We've broken down those 46 companies into sectors to get a picture and to get a sense of how sectors have performed in the quarter gone by. So 46 out of 50 companies have reported the numbers, 20 have been above expectations, 9 below, 13 in line, and 4 companies have reported mixed set of numbers. Let's get into the top 5 sectors which have reported highest revenue growth in the quarter gone by. At the top end, we have consumer goods, we have auto and auto ancillary and capital goods. All of these sectors have reported growth anywhere between 25 to 120%. Oil and gas and consumer durables have also reported 20% plus revenue growth in the quarter gone by. Those are the top 5 sectors which have reported highest revenue growth. Let's also put the spotlight on the other end of the spectrum, the top 5 sectors which have reported slowest revenue growth. And at the bottom end of this, we have FMCG with a revenue growth of about just 1.5%. Other than that, we have healthcare, we have construction, power and financial services with revenue growth in single digit ranging anywhere between 4% to 10%. Let's shift focus to EBITDA and profitability metrics then, and top 5 sectors which have reported highest EBITDA growth. At the top of that list, we have consumer goods yet again, consumer durables, metals, financial services and oil and gas. All these sectors have reported 20% plus EBITDA growth in the quarter gone by. But there are a couple of sectors which have reported EBITDA degrowth on a year-on-year basis, and FMCG is a part of that list. 7% EBITDA decline on a year-on-year basis as far as FMCG sector is concerned. Construction at about 3.2%. We have services and healthcare sector which have reported EBITDA decline of about 8% and 14% respectively. So yes, FMCG clearly has been at the lower end of the pyramid, whether it is revenue or EBITDA. But on the higher end, we have consumer durables and consumer staples which have reported fairly decent numbers as compared to the other sectors.
Okay, Ashesha, thanks so much for taking us through that. Anand, give us a quick roundup of how you've seen the earnings shape up so far, particularly for the Nifty pack. Like Ashesha was highlighting, it's been a mixed set coming in from 4 companies about, but more or less, there has been a beat compared to what the street was estimating. Your thoughts here?
Yes, the broader market, especially smaller companies, have done well. However, I think, if you really want to look at where the market is, you still have to look at the larger companies. And for the most part, as I said, other than autos and consumer, the earnings have been in line. That itself is a bit of a relief because by and large, you start the year with a 15% earnings expectation growth, and then that slowly tapers down to single digits. This year, at least, we have not seen that happen so far. Whether it will happen in the next half is still a question mark, but I think for now, at least, it is looking quite good. Commodities will continue to play a good role. The quality of earnings, therefore, to some extent, is worse than what it has been historically. You are being led more by global commodity prices and so on. I think that's another trend that will likely continue. For example, I expect to see oil prices stay elevated far longer than the market perhaps is anticipating. And therefore, you will have benefits from the fact that companies like in refining, etc., will benefit both from the fact that there is now a shortage of refining capacity globally, and therefore marketing margins are up, as well as the fact that because crude is up, and unless the government comes in and restricts your pricing power, you will be able to make a reasonable margin on the refining. So those kind of companies, I think, will continue to do well. I expect second half to be reasonable, at least for the next 2 quarters, because of the consumption growth that is likely to happen. Assuming all this, of course, assumes that there is nothing new that happens in the global markets and no new threats come through. So by and large, the scenario is reasonable. Valuations are still on the higher end, so that doesn't give you too much on the upside. But at least for now, there is no particular reason to be negative on the market overall.
Any way to tactically play this, Anand? We are seeing gyrations on the Nifty, by the way. We'll talk a little bit about that. But any way to play any of these trends that you're talking about, higher crude, how much of this is already priced in? Also, I'm guessing higher metal prices as well is what you're penciling in.
Well, metal prices perhaps not so much, but yes, higher. Of course, I'm talking when we talk about metal, we talk about.
Okay, we've lost the feed for Anand. We'll get him straight back, and we'll talk a little bit about that with him, how to play that tactically. Let's talk about cash, and let's talk about the moves that are playing out given the cash segment, which is live as we speak. The Nifty is flat, though, absolutely flat through this cash segment, through the last 20 minutes or thereabouts. In terms of the big moves, I'll just quickly cover them first. Asian Paints up around 0.5% or thereabouts in the last 15 to 20 minutes. BEL is the other one, which has been a decent mover over the last 20 minutes or so. And so is Eternal. Eternal is now up 2.5% for the day gone by, and 0.5% higher in the last 20 to 25 minutes. So those are just some of the movers on the Nifty index. Let's also, if we can, pull up the Nifty and try and see and break down as to what's playing out on the Nifty itself. There you go, flat move on the Nifty in the current segment. Let's go back to Anand. Anand, please go ahead. Give us a sense. How do you play this tactically, and the view on metals?
Well, I mean, the best way of playing it is to actually buy the commodities, right? I mean, buying it through companies becomes a problem because each company has their own quirk. So the best way is to buy the commodities. And if you're looking at companies, unfortunately, in India, as I mentioned, oil and gas is a regulated sector. Steel is controlled by, steel prices are controlled by the tariffs that the government puts in. So those are well-protected sectors and can continue to do well. But most of the larger companies have exposure overseas. So as a consequence, the global market does make an effect. So therefore, the better way if you want to play directly is to buy the international companies or the international commodities directly. One thing that one has to keep in mind is that there is likely to be a major shift in the way the Fed, US Fed, deals with its size of the balance sheet. And if that were to come through, they have put out a paper and a research report in the past about how they would like to shrink it. Then some of these issues will come to the fore of tightening market and liquidity. We've already seen what that is doing to what's happening in Japan and versus US dollar versus yen, where the central banks are unable to stop the flow of the market. And therefore, you may find that market tightening may actually upset many of the carry trades even further going forward, given the differential that we have between the Indian interest rates and the international interest rates. Aside from that, there is nothing much that I see, which will cause a major, which will rock the boat a lot.
On that note, Anand, I just wanted to get your view that, we're in the last week of earnings. Once the earnings are done and they're digested by the market and we're beyond that, what do you think the next trigger could be for the market to grow from here, if at all that's something that you're seeing?
It needs to trade every day, so it will find some reason for it to go up and down. And you can talk about El Nino, or you can talk about the Iran war and or some other event or the other. But the fact of the matter is that what we are looking for is overall long-term earnings growth. and that doesn't change necessarily on a day-to-day basis. So there's enough for the news anchors to talk about. I don't think from an investment perspective, you need to look at every gyration of the market.
All right. Anand, thank you so much for coming in, giving our viewers that perspective. Really appreciate you taking out the time.
Thank you.
All right, and we're timed out on this edition of Closing Trades. But before Snehi and me let you go, we're going to quickly talk about the FIBAC 2026 event. The RBI Governor, Sanjay Malhotra, says that the geopolitical uncertainty from the West Asia crisis still weighs heavy. He also talks about the new roadmap for the Indian banking sector. Listening to that, thereafter, we'll go across, in fact, to Ashesha on our special segment, Commodity Central, where Ashesha speaks to Mahesh Palawat from SkyMet Weather Services with regard to the rainfall.
If you were to ask me two important risks, I think Ruchin was quite spot on. One is uncertainties. I'll put it a little differently, though. One is, geopolitical uncertainties which we are facing, and it's not only, the West Asia crisis, but a lot of other uncertainties. The fundamental is financial stability. We need to continue to work on financial stability because that is really, the bedrock. You cannot have growth without financial stability. So this is, the preconditions. I may mention that even banks, we have allowed the banks to invest in these alternative investment funds up to 20% for each fund, 10% for a regulated entity. So we are also supportive of investments in highly research-oriented and intellectual enterprises and intellect-driven enterprises